Welcome to the Deep Dive, where we cut through the financial jargon and give you the knowledge you need fast.
Yep, and today we're tearing into the Q3 2025 earnings call for Stanley Black Decker.
It's quite the puzzle, this one.
It really is. We have a fascinating mission ahead of us because SBD, well, they delivered a clear operational beat,
Yeah, solid numbers operationally.
But the market reacted negatively, selling off the stock. So our job is to strip out the confusion, try and understand this central conflict.
Why did good execution today lead to caution about tomorrow?
Exactly. It's the classic short-term versus long-term tension, isn't it?
Absolutely. So let's start with the immediate numbers because, look, they were objectively strong on the bottom line.
They were. The headline adjusted EPS came in at $1.43.
Which significantly overshot analyst consensus. That was closer to what, $1.19?
Around there, yeah. So that's a massive beat on adjusted earnings.
It is, but you have to look at the top line too, right?
Yeah, right. Revenue hit $3.76 billion, which basically translated to flat year-over-year sales. And that was actually a slight miss against expectations.
Okay, so a beat on adjusted earnings, a slight miss on revenue.
And here is where we need to introduce the nuance right away.
Yeah.
The company reports two different earnings numbers. It can get confusing.
Exactly. So we see the adjusted EPS beat, but the GAAP EPS that's generally accepted accounting principles, that came in much lower, $0.34.
A big gap.
So for everyone listening, why do management and the street, tend to focus on the adjusted number in cases like this? What's it actually excluding?
Well, think of it this way. GAAP is like the formal accounting rule book, the official ledger.
Okay.
Adjusted EPS is what management presents as reflecting the true ongoing operational health of the business. It strips out major, often one-time items, especially non-cash charges.
Things that aren't part of the day-to-day running of the business, essentially.
Precisely. So when that adjusted number beats expectations, it signals their core transformation, their turnaround plan is working.
And crucially, before we get to the guidance that spooked everyone, there was another really positive operational sign.
The gross margin expansion. Absolutely.
Yeah, tell us about that.
Adjusted gross margin rose to 31.6%. That's a gain of 110 basis points year over year.
And a basis point, just for clarity, is 1/100th of a percentage point. So that's a solid improvement.
It is. And that margin gain is driven by, disciplined pricing and those efficiency gains we keep hearing about.
A self-help story.
Exactly. It's concrete, it's measurable progress right there in the margins.
Okay, let's dive into the core conflict then. The guidance revision. This is really where the caution stemmed from, isn't it?
This is it. The revised full year 2025 adjusted EPS was trimmed just slightly, down to approximately $4.55 from about $4.65 previously.
Now a 10-cent reduction. I mean, it might not sound catastrophic on the surface.
No, but the stock reacted like it was because the market hates uncertainty and it really hates cost surprises. Management attributed the cut in that adjusted guidance to higher than anticipated production costs they saw in Q3.
Ah, okay. Production costs.
And these costs are linked directly to their massive supply chain restructuring. Specifically, that tariff mitigation response plan they've been talking about.
Temporary. That's the word management used, right? You mentioned these costs were temporary.
They did.
Does the market have confidence that those tariff mitigation costs really just vanish in Q4? Or is there a risk this bleeds into next year, impacting the whole turnaround story?
Well, the street is clearly skeptical. I think that skepticism is exactly what drove the stock down.
Makes sense.
Management insisted these are short-term bottlenecks, tied to rapidly shifting production around. They expect it to normalize.
Thank you.
But the execution risk in moving a massive supply chain like theirs, well, you just can't ignore it. And that's why the stock reacted the way it did.
Okay. And then there's a much steeper cut in the GAAP guidance. That fell from around $3.45 down to somewhere between $2.55 and $2.70. That's a big drop.
Huge difference. And that needs clarification, definitely.
So what's driving that?
This is where we talk about the strategic decisions being made. That massive gap between adjusted and GAAP guidance is primarily due to a substantial non-cash asset impairment charge.
How substantial?
$169 million pre-tax recorded right there in Q3.
Wow. Okay, non-cash, but still a big number. What's it for?
Think of it like management cleaning out the closet, strategically speaking. They are really doubling down, prioritizing their powerhouse brands.
DEWALT, Stanley, Craftsman.
Those are the core ones, yes.
So this $169 million, it isn't cash leaving the building today. It's an accounting charge.
Correct. It's the company saying, look, We are strategically writing down the accounting value of brands we are deliberately de-emphasizing.
Which ones specifically?
Specifically, Lennox, Troy-Bilt, and Irwin were mentioned.
So couldn't you argue that $169 million charge is actually, well, a good sign that management is getting serious about sharpening the portfolio focus?
You absolutely could, and I think that's the intended message. It signals a complete commitment to their core professional and mass market segments.
It might look painful in the accounting ledger now.
But it simplifies resource allocation down the road.
Yeah.
And it accelerates focus on what truly drives profitability moving forward. It's a strategic clearing of the decks.
Okay. Despite all that earnings noise, though, there's tremendous stability in one really important area: cash flow.
Yes, cash flow discipline. The full-year free cash flow, or FCF, target remains unchanged, still aiming for $600 million.
And they generated a good chunk of that in Q3.
They did. $155 million in FCF just in the third quarter.
That FCF stability, that's got to be a key positive, right?
It's a key differentiator, absolutely. It shows that even while they're investing heavily in this restructuring and dealing with these short-term production cost hiccups,
The underlying engine is still healthy.
the underlying engine of cash conversion remains incredibly healthy. Yes.
But, okay, if they're generating all this cash, why are they using it primarily to improve the balance sheet and pay the dividend? Why not immediately accelerate the tariff mitigation? Or maybe do some big share buybacks to signal confidence?
That prioritization tells you a lot about their current view on risk. Meaning they see balance sheet strength as paramount right now. Their immediate goals are fund the business, maintain that dividend, which is really crucial for their long-term investor base, and strengthen the balance sheet.
So buybacks are off the table for now.
They stated pretty clearly that share repurchases are only a preference once net debt to adjusted EBITDA gets sustained below 2.5 times.
Right. So in simple terms, they're de-risking the foundation first.
Exactly. Before they attempt any, let's say, market engineering with buybacks. Foundation first.
Okay, let's shift gears to the operational backbone, the thing that made that margin expansion possible. The Global Cost Reduction Program. That's been running for a while now.
It has.
How close are they to hitting that massive goal? What was it, $2 billion?
$2.0 billion is the target, and they are well within striking distance.
Really? How much progress in Q3?
They achieved another $120 million in incremental pre-tax run rate savings in Q3 alone.
Wow.
That brings their cumulative progress to an impressive $1.9 billion.
$1.9 billion out of $2 billion.
Yep. They expect to hit that critical $2.0 billion target by the end of 2025. I mean, this is undeniable execution on the cost front.
So they're basically 95% done on the cost side, but the market seems totally focused on that 6% volume decline we saw.
There's a disconnect.
Why isn't this massive cost discipline buying them more goodwill with investors right now?
Because the market is worried that volume is, the tide that lifts all boats.
Yeah.
And right now, for parts of their business, the tide is out.
But the savings are real.
Exactly.
Yeah.
This $1.9 billion in savings is structural. It's baked in. And it directly supports their ambitious long-term adjusted gross margin target. Just 35% plus. That's the goal. And they're targeting achieving that or getting very close by the fourth quarter of 2026.
Okay, that 35% margin goal, that must tie directly into that huge supply chain shift you mentioned earlier. Moving production out of China?
It's a key enabler, yes.
Moving production from China to Mexico. I mean, that sounds like flipping an aircraft carrier. It feels necessary, but not something you do quickly or easily.
No, it's a massive undertaking. But the timeline they've set is rapid.
What are the concrete goals? How much reduction in China sourcing are we talking?
So they plan to reduce the U.S. cost of goods sold, the QGS sourced from China, which was about 15% in 2024, down to less than 10% by mid-2026.
Mid-2026, less than 10%.
And then less than 5% by the end of 2026.
That's fast.
It is. And this is why we saw those temporary cost headwinds in Q3. They are moving high-value stuff like cordless tool production very rapidly to Mexico right now.
Okay, and to maintain investment while absorbing these shifts in costs, they're pushing through another price increase.
Correct. A second price increase is coming in Q4. Low single digits is what they said.
Okay.
Management emphasized this is necessary to keep funding innovation, especially with these persistent tariff cost pressures.
Right. It shows that even with volume softness, they feel they still have some pricing power.
Which is critical for defending those margins, absolutely.
And let's look quickly at the segments. Overall, organic revenue for the whole company declined by 1%.
That's right.
And that was a 5% price benefit being completely wiped out by a 6% volume decline. Ouch.
Yeah. Volume was the issue.
That volume soft spot must be concentrated mostly in the tools and outdoor segment, right? That's the biggest piece.
That's exactly where it hit hardest. Tools and outdoor saw organic revenue decline 2%, and the volume drop there was primarily driven by soft consumer and DIY demand.
People pulling back on big home projects, maybe?
Seems like it. And also maybe some promotional reductions tied to managing those tariff impacts.
But the internal strength, the counterweight, comes from the professional side?
Absolutely.
Yeah.
The massive highlight here, as always it seems, is DEWALT.
Still strong.
Their professional brand remains a powerhouse. Management said it's maintaining strong momentum, pacing or even exceeding the market across product lines.
So the pro contractor segment is holding up.
It remains steady, yeah.
Yeah.
And that provides a really resilient floor for the whole company against that DIY weakness.
Okay. And the actual growth driver in the quarter came from the non-tool segment. Engineered fastening.
This segment was the standout, definitely. Engineered fastening revenue grew 5% organically.
What drove that?
The real engine here was the aerospace business. That delivered over 25% organic growth. Just phenomenal.
Wow. Why such strong growth there?
Robust demand and a really solid backlog.
Yeah.
The aerospace cycle is clearly very strong right now. Automotive also chipped in with low single-digit organic growth.
So that diversification helps smooth things out.
It's invaluable when the consumer market gets volatile like this.
Okay, so summing up the environment. Internally, they're rebuilding profitability, hitting cost targets. Externally, they're navigating this split market. Soft DIY consumer versus steady professional auto and aerospace.
That is the perfect summary of the macro backdrop they're facing.
Now, if we connect this internal operational success to that external context, we kind of see the market skepticism reflected in the stock price, right?
We do. If you look over the last year, SBD's total return has significantly lagged the broader industrials ETF, XLI.
And XLI, for those unfamiliar, that's the ticker for the Industrial Select Sector SPDR Fund. It's basically a proxy for the whole industrial sector.
Right. So the fact that SBD is lagging suggests the market is heavily discounting all this operational turnaround effort we've just detailed.
It's like the market saying, show me the volume growth.
Pretty much. It means the market is entirely focused on the cyclical risk that volume weakness and is treating SBD almost like a cyclical deep value play, just riding the economic waves.
But the argument is that misses the internal changes.
Exactly. The underlying thesis, the bull case, if you will, is that when consumer volumes do eventually stabilize or turn positive,
Which they presumably will at some point.
right, the company will have built this structural advantage thanks to the near completion of that $2.0 billion cost program and the progress towards that 35% margin goal.
Meaning the earnings power on the next upswing could be massive, much higher than before.
Significant operating leverage, yes. That's the idea.
Okay. Looking immediately ahead then, what's the expected adjusted EPS for Q4 2025? What are they guiding for?
For Q4, adjusted EPS is expected at approximately $1.29.
Okay.
But perhaps more importantly, looking into next year, management projected $350 million to $400 million in gross productivity for 2026.
Meaning
Meaning they expect continued year-over-year gross margin expansion into 2026, pretty much regardless of what the macro environment does.
so that margin rebuild, they see it as baked in now, driven by their own actions.
Largely, yes. That seems to be the message. It's structural improvement.
Okay. That sets the stage perfectly for our final thought experiment segment.
Yes. Time for some speculation.
This is not financial advice segment. Just one super clear. We're presenting a trade idea based purely on the information from the call and reports. It's conceptual, it's speculative, and it's purely for entertainment. Don't try this at home, basically.
Got it. So the setup is this. The market seems to be valuing SBD based mostly on the near-term volume weakness and those guidance revisions.
And arguably ignoring the operational wins.
Ignoring or heavily discounting the demonstrable wins, like the margin expansion, the FCF stability, the cost program nearing completion. The stock is acting like a simple commodity business, maybe?
When the argument is management is actually executing a structural margin rebuild.
Exactly. A fundamental improvement in profitability.
So we want to place a bet, conceptually, on that operational execution while maybe hedging against the broader macro fears holding the stock back.
That's the idea. What's the high conviction setup to express that view?
Okay, lay it on us.
We'd call it a margin decoupling arbitrage.
Sounds fancy. What does it involve?
You'd execute a long position in SBD equity buying the stock, paired with a short position in the Industrial Select Sector SBDR Fund, XLI.
Okay, long SBD, short XLI. Walk us through why shorting the broader industrial sector helps isolate SBD's specific turnaround story.
Well, it hedges out the broad industrial and cyclical risk, that macro noise we talked about.
How so?
If the entire economy, the whole industrial sector, goes south, your loss on the SBD long position should be partially offset by the gain on your XLI short position.
Ah, I see. So it neutralizes some of the market-wide movement.
Right. The bet becomes much more isolated to SBD's internal self-help story. The conviction is that by late 2026, when they get close to that 45% adjusted gross margin target and the $2 billion cost out is fully done,
The market will finally have to recognize the change.
the market will re-rate SBD based on its dramatically strengthened underlying profitability, hopefully decoupling its stock performance from just the flat or weak revenue environment. It's basically a pure bet on operational execution winning out over macro sentiment.
Interesting. Definitely conceptual, but interesting. Okay, let's recap this deep dive then. You have this clear dichotomy, this tension.
Yeah, strong operational progress on one hand, the adjusted EPS beat, the margin gains, hitting that cost control milestone, really solid execution.
But that was clearly overshadowed, at least in the market's eyes, by the cautious guidance revision and that persistent volume softness.
Which is driven, in part, by the necessary but costly and disruptive tariff response and supply chain shift.
So the real question for you, the listener, the informed observer, moving forward is probably this.
Will that strategic decision to impair the non-core brands to really clean out the closet and focus, will that unlock sufficient management attention and resources?
Enough to really accelerate the high-growth DEWALT story, and crucially, achieve that ambitious 35% margin goal by late 2026, even if volumes stay sluggish for a while.
That strategic focus versus the execution risk. That really defines the risk and the reward from here, I think.
A lot to think about. We appreciate you joining us for this deep dive into Stanley Black & Decker's Q3 2025 results.
Yeah, thanks for listening.
We'll see you next time on The Deep Dive.